and we're doing quite well this year after a rough December for a lot of people. Um, so today we're going to talk about what the prospects for a monster rally are in 2019 and sector and stock trading strategies. So a little word from the lawyers. This presentation is for informational purposes only. It is not an offer to buy or sell any securities. Past performance is not a guarantee of future results. Consult with your advisors in the trading room and everybody else, and use your head and do your own due diligence, etc., and so forth. So I'm going to give it, for those who are uninitiated, a little background and history, go over our philosophy and process quickly, and talk about this midterm sell-off, how it set the stage at the end of the year for a 2019 pre-election year rally, as well as a forecast and outlook update and some current analysis, a little best 6 months switching, which we stayed in consciously without a stop, some tactical sector rotation strategy stuff. I just happened to see the watching the tape over there with the pound down, obviously from some Brexit issues as well. But there's a seasonality from the old Commodity Traders Almanac coming up. You got no sound on me? The weather is getting snowy here. Is the sound okay over there? I have somebody saying, okay. PA Trader said no sound, but maybe it cut out. So the pound trade coming up at the end of March out of the Commodity Almanac is something that you might want to be looking at for you currency traders. We call it the March British Pound Invasion, but it's really related to the um, British fiscal year. At the end of August, so from about mid-March through a latter part of August, there's a decent rally in the pound, and we can look at that a little bit. But the Commodity Traders Almanac will be updated and put out for 2020. So that's just a little late-breaking thing here, and then we'll talk about our stock selection process and a couple other stock trades. I don't know if anybody got into the free lunch basket we put out there, the only free lunch on Wall Street, the new 52-week lows on triple witching Friday in December. Anyone get that? It's pretty popping this year. Anyway, we'll show you a little bit of how it happened, but it's something to keep in your radar for the future, especially you nimble traders. So some of these things in this presentation, this is basically how to use the Almanac and the kinds of trading and investing ideas we put out in our newsletter at Stock Traders Almanac every year, every month, every week throughout the year. And, for traders, when I talk to them, some of these things are a little bit slower, longer time frame, but for some of those trading profits you had, these types of things, in addition to some of the opportunities for quick trades in our work, some of these strategies and portfolio allocations are good for those trading profits. So let's take a look at the history. 52 years in the street. You guys know what we do, where we've been. The 2019 is out. The old 68 original edition that Yale put out back in 67. Some of the other books we put out there. The Super Boom forecast, many of you heard about, is looking pretty spot on, even though everyone thought I was nuts back in 2010 with the Dow at 10,000 when I made that forecast in May of 2010. Some of the places that we get to appear and get quoted, in addition to Mr. Topstep, as well as the Stock Market Cycles book. That's a little book that continues to get picked up, and people should be following up on that and reading that. So our philosophy, what Santayana said, that those who fail to remember the past are condemned to repeat it. We feel that those who study market history are bound to profit from it. Always keeping an eye out for things not being exact for rhymes, and Sam Stovall reminds us using history as a guide, not a gospel. In order for you to get these trades when they come out, here's a special offer for you folks. It's 57% off for the 2-year, $250 for 2 years. You get an almanac every year, $150 for 1 year. You get the almanac sent to you when it comes off the press or when you subscribe. 1 year is 1YR19 MTS, and then for the 2 year it's 2YR19 MTS for Mr. Top Step. So that's the offer. We've been doing this for 50 plus years. Yes, I am 52, as old as the Almanac. Yale started this back in 66. I took over 2000, 2001. For those of you wondering his status, he is 95 and living in a nursing home with mom. They definitely are forgetting a lot of things, but they're still kicking and having some, fun, and they're together. So we've been studying every market trend imaginable, publish the findings on an annual basis. We update weekly and monthly in the newsletter, as well as our blog, which is Almanac Trader. It's at Tumblr. You can track it on Twitter at Almanac Trader, as some of you already do. And constructing portfolios, we rely on, of course, cycles, seasonals, and fundamental and recurring patterns as our foundation. But we do look at very deeply at fundamentals and technicals, especially with the stock picks. I look at internals and sentiment. The AD line's looking pretty good right now. Sentiment had got really ugly back in December. Talk about that a little bit more shortly. Of course, monetary and government policy, always interesting, and even more so these days, and current trends in the economy, which seem to be maybe growth slowing a bit, but still pretty solid. So the fundamental technical support for the rally, fundamental side, oh boy, I got some stuff popping up here. I'm updating my trade navigator in the background. I'm not sure that that's the wisest thing, but in case I wanted to show you guys some things, I figured I'd update that. Anyway, GDP still forecast for Q4 2.7. Earnings still growing, though slowing a little bit. Unemployment still incredibly low. The jobless claims number was probably seasonal effect of holiday fires, post-holiday firings, or letting go. Housing and autos have been kind of soft, maybe firming up a little bit. Seasonals were in the best 6 months. We got a positive January trifecta. Some of you guys saw that slide that was sitting there when I first put up my screen. And of course, the pre-election year is the strongest of the 4-year cycle. Monetary policy, I guess Powell got the message from the market. I would say more so the market than Mr. Trump, but that's my opinion, and everyone's got one. Technicals, high and lows have improved. 80 lines doing better. Now we've reclaimed the 200-day. I think the Russell did it yesterday as well. So we are bumping up against some resistance, but market's still looking pretty solid here. And the best indicator of market action is the market itself. So gains beget gains. Sentiments still kind of neutral. Had gotten really low. Put call spiked. I used the weekly put call ratio, the equity only. The CBOE used to be tracked in Barron's pretty easily, but now we got to do it ourselves because Barron's scrapped our lab pages, which is a crying shame. Strange relative strength stochastics, MACD positive. They're looking a little stretched though, and we've had this nice rally since December 24th. And if I'm not mistaken, on the political forum, despite some of the rhetoric, I think Mr. Trump is tacking the center a little bit, at least with the shutdown avoidance the second time here. So things are looking positive. The point of the 4-year cycle is really, well, the 3rd-year strength is what presidents do to get reelected or keep the party in power, is prime of the pump. And they do all sorts of things that they feel will not necessarily just push the stock market higher, but make the electorate quite happy when it comes election time the following year. So 3rd year is still the best. You can see on the left, the Dow, 15.8% in the pre-election years, the 3rd year, like 2019 of the 4-year cycle. Post and midterm have gotten a little bit better these days. Election years, we've had some rough elections, 08 and 2000 especially. And then on NASDAQ side, the gains in the pre-election year since 1971 when NASDAQ started is pretty impressive at 28.8%. One of the positives for this year, midterm years, we did get our correction a little bit late. I think that's part of the support for the rally and the setup here. We have had late midterm corrections. 74 was it the Dow bottomed in October. S&P was December. If I might have flipped that, but still these late sort of midterm year corrections are not incredibly. No, it was the Dow that bottomed in December. S&P bottomed in October of 74. So the 1 year seasonal pattern, one of our go-to tools for analyzing seasonal patterns in markets and commodities and sectors. Less so stocks for us. I know a lot of people are doing some things with individual stock seasonality, but our 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 take is that the sectors and the market really are something that's seasonal, and stocks sort of go with their sector, and then we look for the fundamental and technical buy points for individual stocks. So you can see here, there's your 28.8% move in NASDAQ on the blue line, Dow and S&P just around 16%, S&P a little bit above the Dow. Again, solid run, but you can still see the worst 6 months, still kind of flat between, May through October for Dow and S&P, and you can see NASDAQ's worst 4 months, July through October, quite prevalent in the pre-election year here. So again, we'll be looking to get protective and a little more defensive come the late spring and early summer. Another feature for the 4 year cycle is the gain from the midterm low to the pre-election year high, where you have some pretty big numbers for the NASDAQ of 70% from that low versus about 47.5% for the Dow. That would put us at over 10.5 on the Nasdaq and up to 32,000 and change for Dow. I don't think we're going to get all that this year. It's been a little bit softer the last several years, but still, if you look down here in the lower end, you can see the last few midterm to pre-election rallies still pretty sizable on both indices. Interesting, highlighting the cluster of October lows on both sides, even also interesting that January has been a large cluster of lows there in the midterm years in January, but December seems to be when most of the highs are made midterm year, and a lot of them on the last trading day. You can see the 30s and the 31s on both sides. So something to keep your eye on for the market going forward, that there is a bullish bias seasonally and cyclically, 4 year cycle wise. The bullish January indicator trifecta. Let me just see you guys got any Q&A over there. Everyone's all right. So Santa Claus rally. Most of you guys realize that it's just the last 5 days of the year and the first two of the new year. You know the famous saying that Yale created: if Santa Claus should fail to call, bears may come to Broaden Wall. So you get a positive rally when 1.3%, when it doesn't show up, when traders who are usually left for that quiet week aren't buying up beaten down stocks or other bargains. And then the first 5 days of January, early warning system, and of course the full month January barometer. As January goes, so goes the year. None of these are perfect. Every time I put something out there, somebody makes a comment. Didn't work last year. No, it did not work last year, but not everything works every year as far as I can tell. But still, the long-term record in all years when we've had a January trifecta, and this is us standing on Yale's shoulders, putting all three of these early year indicators together instead of just one at a time, and the results are more robust. You can see full year gains going back to 1950 with the positive trifecta, 17.1% on the S&P, up 27 of 30 years, only 3 losses. And just to be safe, make sure we're not including January's gains, the last 11 months of the year, up 26 of the 30 times with a 12.1% gain. So no matter how you slice it, the January indicator is positive for 2019. Our market at a glance is a major feature of the newsletter service. And I don't want to read the whole thing, of course not, but I want to give you an idea of how we present it. And the slide earlier where I sort of summed up the fundamentals and technical support comes with sort of a summary of this. So you can see we have a nice, short, sweet analysis of the 5 disciplines we look at: psychological, fundamental, technical, monetary policy, and geopolitics, as well as seasonality, our bread and butter. So that's just a peek at that. Pulse of the market, another feature out of the back of the Almanac. I don't know if you guys have one, but anyone's got one on hand, they can flip back to the page like 184 is the weekly uh, 185, excuse me, the weekly indicator um, data first half. The next page is second half. You can see we've transferred this over into the newsletter, and we do it in Excel, of course. But you can see the tracking the Dow itself, and then the down Friday, down Monday, which you can see this cluster back here in December, quite a negative. But when you get a few of them in a row, you often get a turning point right there, like we had on December 21st and 24th, with the minus 414 on the Friday and a minus 653 in the Dow on Christmas Eve, which I've called the Christmas Eve crumble, if you will, and even if you won't. Nasdaq and the S&P having some pretty strong weeks leading up to January. The internals, you could see things got really negative just before Christmas, with lows outweighing, decliners, excuse me, outweighing advancers by a margin of more than 10 to 1. Same thing on the new lows and new high side. You had 1,600, excuse me, and 48 new lows and 12 new highs on that triple witching Friday there, which made it a great opportunity for the free lunch menu that we picked. Put call spiked to its highest since about 2016, January, February, with 0.92. Not quite that over one that we love to see, but still an important bottom there, as indicated by the sentiment. And rates have continued to come back. I think the 30 years back under 3 now, if I'm not mistaken. We're still hovering right around it. So that's a look at our pulse of the market from last month. We do this at the end of every month. We do follow this stuff throughout the month, but for the newsletter, we update it monthly, give a little bit more of a patient look at things. Our forecast that we also put out just before Christmas, at the time we had, this was the Thursday before that big Friday, the 24th sell-off. We lay out a few scenarios: worst case, base case, best case. If things didn't get pulled together and the Fed remained hawkish, we were thinking we could end up in a bear market that would, continue into 2019 and 2017. But our base case looks and best case look more likely now. Something did give. We didn't get a bear market bottom. It was a pretty sizable correction, even by the Ned Davis research standards. It wasn't enough time for that type of about 13.5% correction. They have worked out a few things. And again, unless Trump gets mullered, I think we can have a typical pre-election year gains, maybe somewhere around the 10% range for Dow and S&P, maybe a little bit more like 20% for NASDAQ. Here's the free lunch as we selected them on the close of December 21st, triple witching, where we get a lot of action. Of course, this strategy works much better when you have corrections. It's up even a bit more. I'll show you I can show you the updated strategy on the website once I get through some of this. But not everything's perfect. We've got some losses here, and we're still averaging 25.5%, and this is over a few weeks. And what's done here is you take of the stocks making new 52-week lows, and we've tweaked this strategy over the years. We're looking for NASDAQ and New York Stock Exchange stocks that are just straight up stocks. No closed-end funds, no preferreds, no new issues, no special dividends, nothing fancy, but regular common shares have been trading for more than a year. And when there's a lot of them, we take the ones that are down the most, and we also take the Saturday after to glean them for any sort of glaring liquidity issues or strange fly-by-night Chinese internet companies or biotech stocks or something that's not quite solid enough, just being oversold for tax loss. That's not just being oversold for tax loss selling. And a couple of parameters. We keep it now within 2% plus or minus of the closing price. So on Monday or whenever you're going to trade these things, if it's the stock is more than 2% up or more than 2% down from the close on triple witching Friday, we pass on it, and then we tack on an 8% trailing stop. Couple of them we could have used 9% this year. We got stopped out of a couple subsequent to this table that ended up turning around and rallying quite strongly after that. So again, quite a solid trading strategy, especially for short-term traders. I know some people can implement option strategies on these as well. Just seeing question over the last physical stock almanac I have is 2015. Yeah, there's some different stuff now in there. Uh, we update it every year. So 2015 is going to be different than 2016 because it revolves around the 4-year cycle. So each year, 2015 was another pre-election year edition. So, and we do change things. Things do fluctuate, and we found, especially in the work for our mutual fund, the probabilities fund, that the intra-month seasonalities change. We years ago, back in the 50s, 60s, we didn't have that 401k, and even in the 70s and 80s, we didn't have that big 401k mid-month injection of capital in the market. Now we see a lot more strength mid-month. So you definitely want to keep track of these things and watch them evolve as society evolves. It's the best 6 months. You can't sell them and go away if you don't buy in October and get yourself sober. We compare different time frames here to check on the validity and you know fact that it's still working. Green line is since the 87 crash, 88 through 2017. Black line is since 1950, the post World War II, and you can see the red line is 1901 back to 1949, and you can see it was pretty much buy in May back then because we used to be more of a farming society, an agrarian economy, and starting in the spring, a lot of money got pushed in the economy buying seeds and fuel and fertilizer and equipment and hiring, and it ran the economy and the stock market up through the summer months into the harvest time. So anyone that goes back much before World War II to refute this strategy is giving you a fallacious argument because it's not relevant before then. Looking at a comparison of the average Dow performance in the best 6 months, November to April, just buying on close on October 31st, selling on April 30th, 7.5% gain versus a 0.6% gain, doing the reverse of that, buying April 30th, selling October 31st. An average, an initial $10,000 investment back in 1950 gains over $1 million in the best 6 months and a mere $1,000 in the worst 6 months. Adding in our trusty MACD timing indicator, just to be clear, we use the 817.9 on the buy side and the 1226.9 on the sell side. A faster, shorter time frame for the buy, as bottoms are more of an event, like we just saw back in December, and tops are more of a process. So we use the slower and longer time frame for the sell, and you can see the gains increase to 9.1%, and the best. The small gain turns into a loss of negative 0.8% in the worst months, and that same 10,000 compounds to nearly 3 million in the best months versus a loss of $6,000 in the worst months. A nice place to park some of those trading profits and trade them over the years, a couple of trades a year. It's a pretty solid strategy, and a lot of our subscribers do it. And just to keep the current, action in our heads and make sure that things aren't fading away, since the '09 low, I've compared the best months to the worst months. NASDAQ, again, is the best 8-month and the worst 4 months, going from November to June. And you can see that the left side, the best months, still outperforming the worst months by a solid margin, though there were a few decent, solid worst 6 months periods, like in 2017, where the market just went straight up. 2016 wasn't too bad. There's a couple of good ones in there, but still, bulk of the gains are made in the best months to this day. Sector trades, stock sectors, different than the commodity seasonalities that we trade. And you can see this big cluster of longs in October, where you have most of the stock sectors coming into season. We have different ending months, and the performance over 15, 10, and 5-year. You see the B, the E, and the M. This is beginning, end, and middle. We break the month up into thirds, similar to our angle on things, looking at the beginnings and ends and middles of things with how markets and sectors perform. There's some shorts in here as well. You got a computer tech short from January to March. We've got gas and um, coming into play right here in February. Again, this is the gas stocks, the companies like the XNG, which would be more like the FCG ETF, but it also runs well with the UNG ETF traded and the gas futures. Utilities is a great sector for the worst 6 months, along with things like staples and healthcare. But that's the overall map. And I'll give you a look at one of the perfect examples with the materials sector trading, you know, not just being long the sector, but being long the best months and short the worst months. Very similar to the best to worst 6 months for the market. You see October through May is pretty solid, and then May through October is kind of weak. Just pretty clear, not a whole lot. You don't need to explain a whole lot there, but just looking at the performance using average over the time frame that this sector's data is available, rotating meaning long the best, short the worst months, 14% gain, just buy and holds 5.8. That same example of a $10,000 initial investment, rotating long and short in the best and worst months for the material sectors is a gain of nearly 400,000 versus a gain of only 48,500 on the buy and hold. So I was thinking I would show you the trade navigator chart here. I'm not sure I got a full update on that yet. Let me see if this thing's done. I think it is. So oil, as you can see, this is the oil stock index, and the oil commodities coming into season here as well. So it's an interesting trade here. You can see on this little dip back here in December, we picked up our XLE, and that continues to move. Maybe if I blaze through these, we can get and we'll look at them live here. What do you guys think about that? Does that sound good? We'll go through the slides, then maybe we'll pull up the live chart to see where we're at. Okay. Is that a yay? Good. We got one yay. So the oil returns to favor in December. You can see that the oil index tracked very nicely with the general decline that we see going into December, and now we're rallying quite a solid setup with the historical seasonal pattern. One of our favorite trades, copper, very similar to the oil seasonality, tends to make its low in December when construction reaches the sort of lull. Lines here tracking, and the orange lines, the FCX, that's Freeport McMoran. That's a great highly correlated stock that tracks the move of the underlying copper commodity in the future. SCCO is Southern Copper. So for people that trade not just straight futures, a couple of options here in stocks that correlate very well. Again, this trades right out of the old commodity almanac, which we'll be updating. The COPX is the copper miners, obviously tracks very closely as well, that ETF. And the copper CPR is the thinly traded ETF for those that might want to trade a commodity ETF instead of a future. Natural gas, I've got two things. I put the future in the open, high, low, close chart to make it look different than the candlestick for the natural gas index of stocks. And I've got the FCG usually tracking very closely with the stock sector index. And you can see the UNG in the orange line tracking the future quite well as well. And again, we picked these things up. Nice little dip back there in February, and I can show. We've got some news coming in here. Hello. I hear a British guy talking about the markets. Thank you. So a nice trade here for the FCG and the UNG for us in our newsletter portfolio. And again, some opportunities and we'll check out where these charts are for futures and options traders as well. Stocks. So we have a bias seasonal overlay, basically looking to get into a basket of stocks for long, small, and mid cap and large cap, somewhere in the October or prior period, August, September, October. We look to get into some shorts and other defensive plays using looking at sector and seasonality and strength. Probably later than sell in May. We wait for some things to start to break and 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 you know fail at resistance or break through some support more towards the line of June or even early July, when July's gotten quite strong, so we want to wait until we get through that period. But in addition to the seasonal overlay that we have, or our fundamental screen, we use Zacks Research Wizard, and we screen for revenue growth and acceleration, earnings growth and acceleration. We look for good margins, great valuations, PE, and price to sales. Ken Fisher's famous metric that we use. We look at cash flows and debt. We want to make sure that there's some decent insider holdings, that there's decent amount of trading volume, and we break them up into 3 market caps. Small is under $1 billion for us, mid is $1 billion to 5, and large is over $5 billion. And one of the clinchers for us is, if we're looking at 2 stocks, all things being equal, we're going to look at the ratings, and not just what the ratings are, and not necessarily even what the ratings are, but how many analysts are following it. We're going to pick a stock, all things being equal, that has a few analysts versus a lot of analysts. So one's got 10, 20 versus one that's got 3, 4, 5 or so. We're going to take the one that's got 3, 4, 5. You want to get these things before they get on Wall Street's radar, and then when they do, you will benefit from people piling into it a little bit as well once they discover the valuation and the growth and acceleration that we discovered in our screen. There was an example which we just got stopped out of, was McCormick and Schmidt. Not McCormick and Schmidt. That's the restaurant. McCormick's the seasoning company, came into our defensive portfolio last June, and then they had an earnings beat that was huge, and it popped pretty nicely. So that's the process. And here's some of the small cap stocks. I can show you the update of this when I jump out of this and go over to the website. You can see here's all the free lunch stocks. We have a couple left from earlier in the year, when we bought in the fall, when we got our basket for the annual October buys. You can see the mid-cap stock portfolio. These are the defensive plays, some utilities, mid-cap utilities from June. A few other, the ones in gray are the free lunch stocks. And then I wanted to show you McCormick and Schmidt. I keep saying that. Why is it in my head? Just McCormick and Company. Nice trade, up 30. So we gave a bunch of that back. And Church and Dwight, a couple of solid staples type companies that were nice, did really well when the market was tumbling in the fourth quarter. Helped hold our portfolio together. So our philosophy is that market gains, you study it, can produce big gains. We've got a couple of highlights here. Global Brass and Copper Holdings. This was the copper seasonal trade against Southern Copper, the same thing. Arista Networks, everyone heard about for a long time, but we were in it 2015 before it popped. United Health, I think I'll just go back there. United Health was still in our portfolio back since 2014. Again, the key to investing, I know you guys are all pretty much traders getting in and out, but I think the same goes for any type of time frame, is sell your losers short and let your winners ride. So that's kind of what we try to do here. On the sector side, some decent trades in financials and materials, tech, and of course the Russell 2000, great seasonal trading vehicle there. And the portfolio, it's now up, when we last updated at the end of the month, up 482% versus about 115 for the S&P. Here's the numbers through the December 31st. Since we conceived this method, this portfolio back in 2001, we've had some drawdowns along with the market, but overall we're outpacing the market by a factor of 3 or 4 to 1. So that's the the run through of what we do. And if you decide to join us, we can have some nice expanded model portfolios. I know not everyone's into growth and income, but it does help for some of those profits. We update and provide analysis and lots of trading investing ideas, from our tactical switching strategy to the sector rotation ETFs and the commodity trades, stock trading ideas. And we're specific with our buy and sell price limits and stops. I showed you the glance, the monthly outlook, and the monthly almanac, telling you what's coming up for the month seasonally, and also a lot of focus on what happens around options expiration. I know there's options expiring all the time, but I still think third Friday of the month has quite a bit of impact. So you get a free almanac for the year every time you subscribe, or for every year you're a subscriber. And here's the code and the offer again. If you want to check that out or give me a call later, happy to help you with that. And then I think I'll open the floor to questions and try to show you guys some of the live stuff. So that was the quick run through. Let me see if I can change the screen that I'm sharing here. Go over here. How often it's published? We put out a weekly alert. I'm going to show you those in a second. I'm just trying to get the share thing up, and I don't want to share my whole screen because that'll mess it up, right? Let's do. It's going to look funky for a minute, I know, but so can you see that right there? Okay. So I'm going to try to do this. So here's our this is our last alert from last Thursday. Oh, I got to log in. So you can see homepage, the basics. Here's the current alert, the wrap up newsletter. Excuse me. And then the most recent alert, I did a little rundown of the top gains through February. Everyone was talking about that. You can see you've got these top 30 February gains. 2019's up to 9.8% when this was done on the 13th. Again, confirming, the January indicator stuff. We put last 10 months in here because this would be at the end of February. Pretty solid confirmation. And then gains in both January and February. Some stuff you might have seen Ryan Dietrich put out from LPL. Again, further confirmation, same number here where we got 12.1 versus the January indicator, but we didn't have to wait for February to get it. Here is update of the stocks. You can see we got, I'm just seeing the delay there. We got stopped out of a bunch of these free lunch stocks. What was the one that just missed? I forget which one it was. Maybe it was Tetra. Just missed it, and it popped a lot. So United Health is still in there. Lennox has been in there for a while. So this is the, you can see Southern Copper we got back into. Freeport McMoran, we got our added at our buy limit, 1064 and 3139. A lot of things are on hold. McCormick gets stopped out on a wacky, release quarterly number. And you can see the portfolio is now up 496.7% versus 126.7 for the S&P. So this is a rundown of our stock update and one of the alerts we put out. I've got a few other ones out here. The seasonal sector trades from the week before. This is a short trade for gold and silver. So our recommendation or our idea was the ZSL, uh, silver short, and gold as well with the DZZ. So a couple of nice trading ideas there as well. Here's our ETF portfolio update from the same day. Just a little stock market analysis up top. I'm not going to stop at everything here, and you can see we've updated the. We got gas. We're in. FCG's flat. Natural gas off a little bit from our buy point. XLE is up 5%, and some of the ones we're waiting on to get in our buy limits. Seasonal switching strategy. We had our MACD buy signal on October 31st. This was the price either at our buy limit or the middle of the day, and we held this without a stop loss because we didn't want to get whipsawed. And right now this is up obviously quite a bit more than from February 6th. And this is the rundown of the whole host of alerts that have come out the past year. You can sign up for its free trial if you want to kick the tires by clicking on one of them, or go to subscribe and you'll see that. I guess I could show you how that looks. So I'm going to open the floor to questions, and we can look at a couple of charts, or we can just leave it there. Anybody have anything in particular to ask me about? I want to ask you about the beach in Florida. Yes, sir.
How you doing, Danny?
What's up, buddy?
How you doing? Good seeing you.
It was fantastic. What's on your mind, my friend?
Well, I asked Raj something yesterday that I think is probably on a lot of people's minds. What do you think? What do you think is more important to the markets right now? The Fed,
Yes.
kind of taking a step back, or these China trade negotiations?
Oh, they're both important. I was contending since the summer that the Fed was the whole risk reward metric for the market, and it sort of proved itself out. I mean, the market cracked when the Fed said we're nowhere near it, and then it popped when he said, "All right, well, pause." I mean, it did have a technical bounce off of that. The shutdown, however ugly it may have been for a lot of people, and it didn't seem to do that much. But China's a big deal, also. I would put a little more weight on the Fed, but that seems to be covered, or at least we have a good read on that right now. And China's important. I was down at the Money Show before I saw you, and I asked around, and I saw Forbes speak and Mark Mobius, and they were both pretty confident that we're going to get a trade deal out of China. A couple other guys, Sosnoff was not so confident. Jack Abbott, I don't know if you know him. He's a market strategist for RIA. He didn't think we were going to get a deal, and he thought tariffs were here. I happen to be leaning towards we're going to get something done. I think it's in both countries' best interest. I think it holds Mr. Trump's political future in the balance. And I think China really needs to work out a deal with us. But it's not going to happen on March 1st.
Yeah.
It's going to get extended, and it's not going to be everything. And if Mr. Trump is the master of the deal, like he says he is, he will negotiate and he will come to the middle. I mean, he took the much less of a deal from the Democrats, on the wall. I know he's talking about this emergency declaration and doing something different, but that's still got a lot of legal work to go around. But on paper, he signed something that accepted 1.37 or whatever the millions of dollars was. So I'm seeing some tack in the center, some negotiating there. But I think if the Fed gets hawkish again, that'll hurt the market. No trade deal, that's going to hurt the market. Brexit, I don't know. What's your take on Brexit? maybe we get a decision and it helps that pound trade that I told you guys about.
Yeah. Trader. Let's see. Let's see who is in here. Um,
Somebody wants to see the gold seasonality
yeah,
trade.
the gold seasonalities. Yeah.
Is that what you're looking for there?
Yeah.
Oh, that's silver. But you know, this is pretty clear. We've got this, this rally following the seasonal pattern. You know, this is one of the, I mean, sometimes you get sick of hearing the word setup, but I mean, this is a setup. You got the actual commodity. You know, this is the near term, the constant, the continuous liquidity one, tracking pretty closely. You know, not exactly perfectly, but dang close to the seasonal pattern, and that just, confirms, excuse me, the seasonality is in play, and it's a good setup. I do look at grains and meats on occasion. It's not a trade that we're into right now. There's fewer of those. Some of the faves, the meat trade is over the summer, and it's a long one. So that sort of sailed from, we don't trade it so regularly like all y'all, if you let me use the plural of y'all, but it's, what is the let me just check back here. It's like it's a summer thing when pardon me, when the meats come down. There's a Thanksgiving lean hogs trade, but nothing's really happening right now.
Well, I think in the meats there's something going on that there's not a lot of people talking about this, but I think there's some kind of like swine flu in China. That
Oh, see, I'm not up on that commodity, the meats and grains stuff. Larry Williams, I'm on this speculators list that Victor Niederhofer runs. Anyone remember? You know who Victor Niederhofer is?
Yeah, we know him. I know him very well.
Yeah, God, he's got to be getting up to Yale's age. And anyway, so on there, Williams just posted something about the grains. There was an article he just put out. I didn't really have a chance to dig into that, but what did Larry say? Yeah, low grain prices mean no loans to farmers.
Yeah,
So
that's not bullish.
no, that doesn't sound bullish to me. But sugar. Let me get back to the trading room. There it is.
I think to answer Julian's question, he'd probably be behooved to get a commodity stock,
Even the 2013 version that was the last one out there still works, but we track these things. So the seasonal trade for cattle starts in June. Headline is summer barbecue season gives beef a bounce, and it runs through February. So we're looking at a top in beef right now, seasonally. And then the grains. There's several different trades. It's mostly buying the summer, selling the end of the summer, selling the harvest numbers. I mean, that's still been around for a long time. And then there's that interesting Thanksgiving lean hogs trade where people start switching. You got the Christmas hams coming and that kind of thing. So polar vortex years. Oh my God.
Yeah, I don't know.
Polar. Listen, when I was in school, we used to have snow all the time, and we had hot summers and cold winters. And I landscaped for years in high school and college. And July was 100 degrees in Jersey, and we
Right.
were we put studs on our tires in the winter before they salted the divots and everything. So, I believe there's global warming. Of course there is, but it's also fluctuations that have been going on for as long as I can remember and prior. So, polar vortex.
Yeah.
Is that when we have a blood moon in October as well? Um, I'm, as you know, more attuned to the collective cultural behaviors of human beings that move larger sums of money into and out of markets on a habitual basis based upon their activities, as opposed to not that climate change and vortexes can't affect uh, people's behavior, but it's got to happen the same time or this around the same time every year and for many years for it to have
A clear
statistical
read.
validity. Yeah.
Yeah, yeah. Okay. Is there anybody else that would like to ask Jeff any questions? Okay.
Not everyone at once. Slow down.
Yeah, yeah, yeah. We got a lot of people in here. Well,
Take it.
anyways, Jeff, it was really great seeing you. I always love listening to your presentations. You're always spot on. One of the things I think that I'll go back to that time that I had you down on the floor of the CME and we were going to talk to what's his name from CNBC.
Santelli.
Yeah, Santelli. And one of the things that I learned from Marty Schwartz years and years ago um, was that historical stats matter. And ever since
Hmm.
he said that, I've been a stock traders almanac guy. You know that. And
I do.
I believe that there's a lot of validity in like, you know, I, like I do, not everything works every time. But if you take a good example of what did work extremely well was the Santa Claus rally.
Hell yeah.
I mean, if there was ever a time that you doubted about the Stock Traders Almanac and the validity of what they do, what Jeff does,